Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in plain sight within corporate filings. Today we're diving into Lease Corporation's latest 8K report. Looks like they're dealing with some interesting developments that might make you say, what's going on here? So Lease Corporation, or ALSI as we might call them, is a big player in leasing airplanes to airlines around the world. Think about it, flying is huge and airlines need planes. ALSI provides those planes now. They're currently in the middle of something called a merger, which is basically when two companies combine. In this case, it looks like ALSI is being bought out by a group of investors. This usually means big changes are coming, and sometimes those changes come with a little bit of drama. The main reason ALSI is filing this report is because there have been some lawsuits filed against them and their board of directors. It seems some shareholders are not too happy with how the proposed merger was presented, specifically with the information that was shared about the company's future financial projections and other details related to the deal. The lawsuits, one filed in Delaware and two in New York, are claiming that the company and specifically its board members have misled or not fully disclosed important information. They are talking about things like the company's expected financial performance, advice given by financial advisors, and even details about potential jobs after the deal is done. Some of these lawsuits are even asking a judge to stop the shareholder vote on the merger, which is a pretty big deal. This legal back and forth is pretty common when a company is being bought out. Shareholders want to make sure they are getting a fair deal, and they are quick to point out anything they think looks fishy. It's like when you're selling your house and the buyer nitpicks every little thing. Here, the shareholders are nitpicking the disclosures the information ALSI is supposed to give them. Now, Alabama C is saying they believe their original disclosures were perfectly fine and followed all the rules. But to avoid all the hassle, the lawsuits, and potential delays, they've decided to provide some extra information. They are calling these supplemental disclosures, and they're basically updating their previous sharing of information to address the lawyers' concerns and give shareholders more details. It's like saying, fine, you want more details. Here you go. Let's dig into some of the finer points of these new disclosures. One key area being updated is the analysis done by their financial advisor, JP Morgan. They've added more details to a section called Selected Transactions Analysis. This is where JP Morgan looked at similar deals. Like when one aircraft leasing company bought another, they checked out a bunch of past sales, looking at something called the price to book value ratio for each. For example, one deal in September of last year between Avalon and Castleake's portfolio had a ratio of 0.98. In August of the previous year, where Standard Chartered's aircraft leasing business was bought by Avilease, had a ratio of 1.36. They've listed quite a few of these, going back several years, and for some, the ratio wasn't even available. After looking at all these and considering the differences between those deals and ALSI's current situation, JP Morgan came up with a range for this price to book value ratio, settling on 0.66 to 1.67. They then applied this range to ALSI's own book value per S-Hair, which was about $65.96 as of June last year. This analysis implies an equity value per S-Hair between $43.55 and $110.15. Now, the deal they are proposing offers $65 per S-Hair. So, based on this particular analysis, the offer price falls within that implied range, but it is definitely not at the top end. They also updated the dividend discount analysis. This is another way to figure out what a stock is worth. Basically, they look at how much money a company is expected to pay out to its shareholders in the future. That is dividends, and then they figure out what all those future payments are worth today. JP Morgan assumed there were about 114.6 million fully diluted shares outstanding. They projected dividends from 2025 to 2032. They also factored in a terminal value, which is sort of like estimating the company's worth after that projection period. They use growth rates for this terminal value between 1.50% and 2.50%. They then used a discount rate which reflects the risk of getting that money in the future, between 8.50% and 9.50%. This whole analysis led them to suggest a value for ALSI shares between $58.3 and $75.2. Again, the $65 per S-Hair offer for the merger falls right in the middle of this range, which is good, but not exactly a home run for shareholders hoping for the absolute best price. Now, for what is probably the most contentious area, the projected financial information. This is where companies provide their own forecasts about future earnings and revenues. It's a tricky area because the future is always uncertain, and these numbers can be heavily criticized if they turn out to be wrong. ALKI wisely notes that they usually don't share long-term forecasts because, well, it is incredibly hard to get right. But To help their board evaluate the merger, management did provide JP Morgan and the buyers with some projections. These cover the years 2025 through 2032. What's interesting here is that they've shared multiple sets of projections. The April preliminary projections, May preliminary projections, July preliminary projections, and finally the Air Lease projections from the 29th of August 2025. This suggests that the numbers have been tweaked and adjusted quite a bit as they got closer to the deal. Let's look at the April numbers first. They projected revenues starting around $2.8 billion in 2025, growing to about $3.4 billion by 2028. Net income to common was high in 2025 at $948 million, then dropped to around $500 million for 2026 and 2027, before climbing back up. They also factored in a significant $493 million from an after. Tax insurance recovery in 2025, adjusted net income to common, which excludes that insurance recovery, was projected at $455 million in 2025. Then came the May projections. Revenues for 2026 nudged up slightly to $2.983 billion from $2.971 billion. But net income to common for 2026 saw a jump to $568 million from $510 million in the April projections. They also increased the expected insurance recovery to $727 million. This shows a clear upward revision, especially in the net income figures. By July, the numbers kept evolving. Revenues for 2026 were projected at $3.125 billion. Net income to common for 2026 stayed steady at $568 million. But for 2027, it increased to $641 million. The insurance recovery remained at $585 million. So, a mix of increases and decreases depending on the year and metric. Finally, the August projections, the ones JP Morgan was authorized to use for their opinion. Revenues for 2025 are projected at $3.034 billion, slightly higher than the July numbers. Net income to common for 2025 is a robust $1.108 billion. For 2026, net income is projected at $594 million. The insurance recovery is now noted at $587 million. Adjusted net income to common for 2025 is $521 million. Looking at the adjusted earnings per S-Hair, the projections also varied. In April, it was $4.09 for 2025, then $5.1 in May, and $4.41 in July. For the final August projections, it's $4.54 for 2025. It's a bit of a roller coaster ride with these projections, moving up and down as the deal progressed. Shareholders will be scrutinizing these numbers very closely. There is also an interesting disclosure about Skadden, Arp, Slate, Mega, and Flom LLP. They are one of the big legal firms involved, and they've represented some of the parties involved in the merger on other matters, including Sumitomo Corporation, SMFG, Apollo, and Brookfield. This is called overlapping representation. It is not unusual, but shareholders often look closely to see if there is any potential conflict of interest. Skadden states the fees from these other representations were relatively small, and that their work for ALSI on this merger is also a small fraction of their overall business, at least so far. They do expect to bill ALS for work on the merger, but those amounts haven't been fully quantified yet, and as with almost any major corporate announcement, they include a forward-looking statements section. This is basically a legal disclaimer saying that a lot of what they are talking about is about the future, and that future is uncertain. They list all sorts of risks, things like not getting regulatory approvals, challenges with employees, restrictions on their ability to take on debt, legal issues, and changes in the economy. They wrap up by reminding investors where to find more information, like the definitive proxy statement and how to request it. So, what's my take on all of this? Well, Air Lease Corporation is in a complex situation. On one hand, they are a well-established company in a vital industry. Planes are always going to be needed. The competition is tough, but they have a solid track record. The fact that they are being bought out by a consortium of investors suggests that there is significant value seen in the company, despite the current market conditions. However, the real story here, as is often the case, is the shareholder activism and the legal challenges. The multiple lawsuits and demand letters indicate that shareholders feel the proposed deal might not be giving them the best possible price, or that key information was withheld. The fact that the company is providing updated financial projections, and that these projections themselves have evolved significantly from April to August, fuels these concerns. It suggests a process of negotiation and adjustment where the initial projections might have been too aggressive or the buyers pushed for more conservative figures. The variation in projected earnings per share from $4.09 to $4.54 over just a few months highlights. The merger itself, led by entities with deep pockets like Sumitomo, SMBC, Apollo, and Brookfield, suggests a belief in the long-term viability and growth potential of aircraft leasing. These are sophisticated investors who do their homework, but their involvement, along with the prominent legal advisors like Skadden, points to a high-stakes transaction. The key risk now is whether the shareholders will approve the deal. If they don't, or if legal hurdles delay things significantly, it could create uncertainty and impact Alc's operations and its relationship with its customers and lenders. For existing shareholders, the $65 per share offer, while within some of JP Morgan's ranges, might feel a bit light given the company's long-term prospects, especially if those higher projections in the August report are believable. The company's ability to navigate these legal challenges and secure shareholder approval will be critical. Alright, that is our deep dive into Air Lease Corporation's latest filing. What is your take on these numbers, the lawsuits, and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more dives into the world of corporate finance. Don't forget to check out our Discord community linked in the description for more discussions. Thanks for watching. See you next time.